Welcome to What Matters. My name is Drew Devine. I am a managing director on PwC's Treasury and Financial Markets team. I am here in PwC's beautiful studios, and I am in conversation with my colleagues, Sandra Cook and Ross Drucker. Our team helps clients with many aspects of Treasury and Treasury challenges, but we have a dedicated area of specialization in financial markets, risk management, and accounting. So think things like foreign exchange risk, interest rate risk, and commodity risk, as well as, I should say, hedge accounting advisory and hedge accounting managed services, or as we sometimes like to say, everything from initial risk exposures to ultimate accounting disclosures, end-to-end advisory support. Now we're here today to talk about what matters in risk management, what matters in hedge accounting, but most importantly, what matters to you. We had a recent PwC Global Treasury survey that indicated that financial market risk is indeed what matters. It was a top 3 concern of both treasurers and CFOs across the survey base. So now, Sandra and Ross, I want to draw you guys into the conversation here today as we think about the volatile markets that we've been experiencing lately. So whether that is foreign exchange or interest rate or commodity markets, what are the things that a corporate treasury practitioner needs to think about to be successful in this new risk environment? And Sandra, why don't we start with you?
Thanks, Drew. I think that when we think about corporate treasury trying to implement a risk management program, you really have to think about 4 cornerstone pillars. And truly successful programs usually have these pillars. They go on a journey. So the planning phase is number 1. The execution phase is number 2. Accounting and reporting are the 3rd and 4th phases. And I think that from a planning perspective, one of the very first things that companies should contemplate is what their risk management objective is. The risk management objective is going to be that North Star. It's going to drive behavior. It's going to include things like what derivative instruments am I using for what purpose. And ultimately, I would venture to say that if I looked at most corporate risk management policies, they're probably going to say something about mitigate risk in the financial statements. But I want to challenge everybody to go a little bit deeper and peel back that onion and think about things that drive corporate performance. Those will be corporate KPIs. Think about things like revenue growth. Maybe it's gross margin at a % or a dollar level. Maybe it's even net income. Or it could be things like year-over-year performance reporting and growth. And so when you have those performance metrics, that set your baseline, and then you're able to make decisions based on that to deliver value. I think going along the lines of your objective is to ensure that you have stakeholder alignment. And as we all know, working in this space for many, many decades, that you really can't go this alone. From a stakeholder alignment perspective, the very first thing I think about is having an executive sponsor that's going to help you navigate some of the challenges that you're going to face. I think that also you should consider all of your inter-finance departments as internal stakeholders, like financial planning and analysis, because they'll set the budgeting and forecasting timelines. They'll also set the processes and procedures around data gathering. Tax is another one. They will set the organizational structure where transaction flows should be. Accounting. Ross has a lot of experience with accounting. It's where gains and losses are going to show up in the financial statements. And then ultimately, your reporting teams, your internal audit teams, things like that. From an external perspective, it's going to be your auditors and then your ultimate shareholders. And then from an execution standpoint, execution really is, I think, about 2 things: data gathering, exposure consolidation. What are those processes and procedures like? And the thing here is you don't have to have perfect information to get started. Start with what you know. Secondly, I think this is where technology can come into play. It can really streamline the process of collecting data, where you can then apply your business knowledge to the information. And then you may be thinking about portal trading for execution of derivative instruments. So for me, I think of everything pre-trade all the way through trade execution, and then also that critical handoff to accounting.
Oh, yeah, completely. So great insights there, Sandra. So I heard you outline four rough areas. I heard planning, I heard execution, I heard accounting, and I heard reporting. Now, on the accounting side, I want to bring Ross into the conversation here a little bit more. Ross, with all of your experience as a practice leading partner here at PwC in the derivatives and hedging space, I understand you did a rotation through the national office, as well as spent some time at the SEC as a fellow there. Can you give us an indication of some of the challenges that corporates face in the area of derivative accounting?
Sure. I mean, look, we all know derivatives and hedging can be a complex and sort of nuanced world, right? It's very strict rules. It's very prescribed guidance, whether you're following US GAAP or IFRS or another framework, right? And so understanding what's required to achieve hedge accounting under that applicable guidance in the US GAAP, it's ASC 815, and just how to deal with derivatives in your financial statements, that's sort of table stakes, right? And so the first thing that comes to mind to me is really around understanding the nature of the risk that's being hedged and sort of what the hedged item actually is that you're trying to get compliance around, and sort of having compliant hedge documentation in that area and a policy that really prescribes what you want to do from an organizational standpoint and from an accounting and policies and procedure standpoint, to me is really the beginning of like what matters after you've identified what the hedged item and what your exposures really are. And if you don't have a full understanding of this, if you don't have a background in the guidance, right, it can be a scary thought to realize, hey, there's all this stuff out there that we need to think about. And that's why, frankly, we're here to help, right? And so at PwC, in our group in particular, we spend a lot of time helping clients with these requirements, helping them establish hedge accounting programs and policies, all the way through the thinking about controls and the financial reporting and the whole gamut of that. But I think overarching, having that policy level documentation done up front and really understanding it is really sort of what matters right now in the beginning. And within those policies, right, you're going to document whether something's in a hedge, whether it's economic or under a hedge under accounting purposes. Everything from the risks that you're defining, the effectiveness assessments that you're using, and the methodology that you're going to be using, following GAAP or the applicable guidance, where derivative gains and losses are going to go and how that actually impacts your financial statements, as well as the disclosures, and so on and so forth, right? So I think that all lines up really well with kind of how we help clients and what the guidance and what we would frankly advise people to do. The other thing I think where technology comes into play is, that plus the accounting is really where the benefits kind of intertwine, right? And so having the synergies and having that together really is impactful here. And so, advice would be, don't go it alone. There's people who can help and who have both the technology, the resources, the understanding, and everything to kind of bring it all together and help companies think through it. The last thing I would say, and I know you touched on this, is just reporting, right? And performance reporting, whether that's the GAAP side of things and the accounting side of things, but also the actual company side of things, and making sure that all the necessary stakeholders in your company understand what the impact is, what you're doing, how it's going to show up in the financial statements, why it matters to you as an organization, and why it matters to your stakeholders. So with all that, I think there's a lot of information out there around what you can do from a hedge accounting perspective and pain points and things like that. But we're happy to help. And I think with regards to this, this is why it matters to you.
Sure, Ross. So much to consider there, and I think you stole my tagline. But indeed, these are the things that matter. One of the things you did mention in there was that some of these concepts can be a little maybe scary up front, but clients do not have to go this route alone. These are things we can help clients out with. So I think overall, outstanding insights, both Sandra and Ross. I think we laid out what I think I heard was 4 foundational principles for corporate treasury practitioners to consider as they're contemplating their own risk management journeys, I think, as you put it there, Ross. Again, planning, executing, accounting, and reporting. So 4 foundational areas. Now, If you need help in your own risk management journey, or you need assistance with hedge accounting advisory or hedge accounting managed services, contact us at PwC's Treasury and Financial Markets team, or stay tuned for the next edition of What Matters. Sandra, Ross, myself, we will see you next time.